Good morning, everyone, and welcome to the workshop designed to talk about how to create rule-based strategies. So, in fact, let me fix my cover slide here. Title is a little messed up, yeah, this is going to be kind of a different format than what I usually do. I usually use, and that is the format this morning is going to be partial PowerPoint, and most of it will be more informal, with actually going in coding and TradeStation. Now, if you use a different platform like NinjaTrader or another platform, eSignal, and you have a different way of coding, the principles are going to be the same with those other platforms. And in the future, I'll try to create a webinar that focuses on those as well. But I'm more averse, I'm used to really coding with TradeStation, so that is typically what I use. Back in the mid-'80s, NinjaTrader wasn't even around. I started using a platform that's still here today called Metastock, and they have a unique logic-based language that they use, but it was a little bit more limited in what it could do back then. And then Omega Research came around after Bill Tennyson and Bill Cruz and Sam Tennyson met in a hotel room and decided to come up with the idea of an easy language with TradeStation. Their first product at Omega Research was called System Writer Plus, and that was great. So that was back then in the late 80s. That was much more powerful than most other options that were available to retail traders. So that was where I started, and so because I have grown up, if you will, on TradeStation, I have primarily used them, but it's not to say that the other platforms aren't good as well. I've heard a lot of very positive things about NinjaTrader and coding. I've looked at their code, and we can do a lot of things on NinjaTrader that we can't even do on TradeStation. So there's positives with all platforms, but they have very different language requirements. I can program, or at least I'm a little rusty now. I haven't done it for a while, but I have been able to program in C# and Visual Basic, and for me, at least, TradeStation is, with easy language, is fairly simple. I can leave and come back to that without a problem. With NinjaTrader, I have to refresh myself a little bit more on the C#-ish logic and the different language requirements there. So it's not as easy for me just to pop in and out of Ninja, although Ninja does have a very good and very powerful language. Okay, will we be able to have access for a short time? Veronica, not sure what your question is referring to with that. If you can clarify that, I will answer that. Okay, access to recording. Oh yeah, the recording is going to be available. It is being recorded right now as I speak, so yeah, this will be put out there excuse me, for quite a while, so we should be in good shape there. Well, I apologize. I actually live down here in Austin, Texas, and I just moved to the allergy capital of the universe, it seems like. So you never really escape allergies down here in Austin. There's always something out there that's lurking. It's strange. If you look at an allergy graph of Austin, if something doesn't get you at one time of the year, something else does. So I'm not sure why I didn't research that more, but it is a fun time to live in, so I guess the benefits in my mind outweigh the negatives. All right, so let's go ahead and get started. Again, this is recorded, and let's go ahead and dive right in. So my background comes from really developing trading systems since I was in college. So since the early age of around, I think it probably started around 18 or 19 years old, I was going to school as a mechanical engineering student. I come from a family of engineers. With all respect to all the engineers on the call today, I never actually wanted to be an engineer. So my father said it's good to have an engineering degree, and so that's where I went. But engineers are great, they're needed, and they are very good typically at making automated strategies. But I never actually wanted to be an engineer. I'm not the type of guy who would go in and take my car engine block apart. That's my little brother and my dad who'll do that. But I more or less just went and was able to thrive in the engineering school because of my love for math, and math is integral in everything that has to do with engineering. But that's where I started from as an engineering student. I was drawn to the markets, and especially the idea of creating an automated strategy that could be used to make trading decisions. And the science of that has evolved tremendously. But that's my background. I've done that for 20 plus years in the hedge fund space, and I've seen a lot of things that work really well. I've seen a lot of things that don't. I've seen surprises out there that never happen in the markets that can be very costly as well. So it's been a great adventure, and we've done really well at times, and we've been challenged at times as well. So I'd like to tell you that trading is easy, but it can be challenging. Sometimes it can be easy, but markets do always change, and we need to make sure we adapt to those. So that's enough about me. Excuse me. Let's go ahead and dive right into the risk disclaimer. Trading or investing carries a high level of risk. It is not suitable for all people. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Just so you know where I come from on this, I want to be completely honest with you. I can make a strategy that would be the best thing you've ever seen. All right, that's not hard for me to do. I can do that in my sleep. I don't do that, though. So it's intentional. If you go to valuecharts.com, you don't find performance results anywhere. All right, and it's not that we can't make them. We can make some of the best you've ever seen. But the reason why I steer away from that is because I can make them, and I know full well from my experience in developing these strategies for hedge funds that it can be very misleading. So, if I make a strategy that thrived in a bull market environment for a market over the past 5 years, it's going to look like the best thing you've ever seen. But we all know that bull market environment is going to evolve. It's going to change. And once that happens, then the results of that strategy are going to change. And so the challenge there is to make sure we always want to be very honest in how we do things at valuecharts.com. So that's intentional. Now, having said that, trading strategies can be very useful, but there are limitations. So understand that. There are limitations to trading, to automated trading. But having said that, I'm a huge fan of automated trading, and I have some ideas on the best way to use automated strategies that I'll try to share some of those with you today. But let's go ahead and talk about how to do that. How do you build an automated system? Now, I think that when you look at the way most people trade, most new traders especially, automated strategies may be possibly a better way to go, as long as people understand what's involved with those and how to design them, how to build them, and how to use them and what they can expect from them. I think they can be a better way to go, because most traders do not have a logic that they're staying with consistently, and that's worse really than anything you can do. Now, I'm going to show you some performance results, hypothetical performance results today, and it's important to understand that these have certain limitations. Past performance is not necessarily indicative of future results. So, so most people who are trading use discretionary trades, trading logic, but I don't want to, by the way, I'm not trying to pour any type of cold water on automated trading. Some of the best managers in the world use automated trading. I mean, the best manager in the world that I've ever seen, they're purely automated. So I love automated trading, but I want to make sure that we don't do what a lot of people do out there. In other words, if you go out to a lot of websites out there, you'll see this, up over 1,000% in the last 12 months, and these outrageous return claims. And we just don't do that, because I don't think that's the right way to go. All right, because that paints a picture that you should have expectations of that happening and continuing on in the future, and that is not the way the world works. All right, now it's not to say that a system can't do well and continue to do well. All right, but I think that setting the stage for throwing return expectations out there, if you're not careful, is not necessarily the best thing to do. And when we talk about returns, I want to make sure that you understand that we are careful to reference the CFTC Rule 4.41. I actually really like the fact that the CFTC has this out there, and I really like the fact that they require people to post this. Okay, so just understand, past performance, even with real performance, past real performance and simulated results have certain limitations, and it's not necessarily something you can expect to replicate in the future. You might actually do better than what you've seen in the past, or you might actually do worse. The problem with simulated results is that a lot of times people pick the best parameters that have done, that they could have used over the past 5 years, and they probably were not in a position to identify those parameters at the beginning of that period. It's a hindsight benefit, and that's not necessarily going to paint an accurate picture of what's achievable in the future. All right, so Again, not trying to start off to be negative at all here. I'm trying to start off to be truthful with you. All right. So now that we know this, take a step back and understand that automated strategies can be very powerful, and they can be very, very good for us to use in trading. All right. But there are limitations. So just make sure you understand that. Now, how to create a rule-based strategy. Make sure that you really understand the emotional demands of trading an automated strategy. So what does that mean? Now, can everybody see my slide that says make sure you can really understand the emotional demands, etc.? I just want to make sure this is advancing okay, good. And obviously you can hear me because you're responding to that. All right, so what this means is that when you test out an automated strategy, it's really easy to gloss over years worth of trading and see these buy and sell arrows and look at these equity curves that go higher. But what you need to do is you need to place yourself mentally behind those trades. So if you see a trade that buys a market, buys crude oil at $105 a barrel, and then all of a sudden follow the price along right after you enter. If the price sells off $3 or $4 or $5 a barrel before it actually turns around and goes in your favor, you need to live that out as much as you can in your mind. Say, okay, I just put this trade on. How do I feel? Okay, I'm starting to get hammered here. Oh no, maybe my trade's wrong. This is when all the doubts start to creep in. Maybe I didn't design the strategy correctly because I'm actually losing money here. So it's the drawdowns, it's the volatility behind entries and exits that you need to address there. Just 1 second, somebody's having problems with sound. Let's try to help out this gentleman here. Is working for all. Okay, consider. Okay, I'm sorry here. Okay. All right. So I'm sending this out to a gentleman who's having problems with sound here. Okay. Now, so again, just live out your trades and put yourself in the situation where you made those. And it's not only a win-loss thing, it's a time thing as well. So it's easy to look at a strategy that's tested out over time, over years of data, and the challenge is go back in time and say, okay, I would have been in this drawdown where I would have been losing money for 3 to 6 months in this trading strategy. Can I do that? Am I capable of doing that? So one of the biggest problems with new people using the rule-based strategies is they don't prepare themselves for the requirements of using them. Now, expect drawdowns, okay? The best managers on the planet, the best hedge funds on the planet expect drawdowns, and you should as well, all right? And they will come. You want to minimize those, obviously, as much as possible, but expect to see drawdowns over time, and prepare yourself for drawdowns as well. Losing trades are a cost of doing business, all right? So if you get bothered by losing trades, don't be bothered by losing trades. Now, that sounds strange for me to say that. Right? They should not be viewed as a negative. Losing trades are a cost of doing business. Now, if you have more losing trades than you do winning trades, and at the end of the day, if you're not profitable, then there is a problem with losing trades there. But it's not a problem with the losses themselves. It's a problem with the ratio of your losing trades to your winning trades and your percentage profitability in your trades. That's where the problem lies. It's not in the fact that you have losing trades. If you ever have a chance, there's a good book called Way of the Turtle by Sam. I was trying to think of the gentleman's name, but I keep on forgetting his name. But he did a good job, and he talked about how losing is a cost of doing business. I thought he did a really good job of outlining that. He talked about some of the cognitive biases that people have behind trading. It's an interesting read. I recommend it if you have a chance. It gives you good perspective on the turtles with Richard Dennis and Eckhart back in the early 80s, but interesting adventure there. So again, don't view trades, negative trades or losing trades as a negative. View them as a cost of doing business. Know when your strategy is not optimized to the current market environment. Now, this is a feel thing, somewhat. All right. Now, it's important to understand that your strategy, it's possible for your strategy to be very out of kilter with the markets. And when this happens, it's not good. You can lose a lot of money when this happens. And usually it's in the form of whipsaws in the market where you're buying at the worst possible extreme, the market turns against you, and then you go back down and sell. The strategies that struggle the most or can become the most damaging are the what we call stop and reverse strategies. So they're not long only, they're not short only, but they whipsaw you around. Once you have a sell signal, you sell your long position, and then you initiate a short position, and then once you generate a buy signal, you get out of your short position and enter a long position. So that's what I mean by stop and reverse. Those are the ones you have to be very, very careful with in terms of being in sync with the markets. All right, and there are some solutions out there when you have a strategy that's not in sync. All right, that's beyond the scope of what we're talking about today, but it is important to understand that, and you want to watch for that. Now, having said that, you also want to make sure that you're committed, that you can live out the losing periods that are part of trading, that are to be expected. Okay, Curtis Faith, yeah, Way of the Turtle, thank you very much, Elaine, appreciate that. I don't know why, it's just maybe too early in the morning here for me to remember Curtis Faith's name, but that's it. Automated trading is something that is going to always require or involve you to live through drawdowns. Now, drawdown magnitude is one thing, and drawdown longevity is one thing, all right? And the challenge as a person who's managed money, millions of dollars for people in the past, is that there's not only, if you ever manage money for people, by the way, you have to not only take care of your own expectations and take care of your own confidence level in what you're doing, but you also have to take care of your investors as well. And I have found, interestingly enough, that magnitude is a bit of a challenge, but if you have short-lived drawdowns, it's not as much of a challenge as duration. So what's interesting is everybody has, expectations are everything. So let me give you a quick example. This is kind of a funny story, but that talks about, addresses how expectations are so important in trading. I had a big client who had, millions of dollars invested in our fund, and we were down that month like 8%. So we really got hit that month. Part of the strategies, it was just a drawdown period, and he had another manager who was a very low volatility manager. And this other manager was I think he was like an arbitrage manager, and he had been doing fairly well. He was up, I think, just about almost every month since inception. So really good track record. We were more trend followers, so we expected more volatility on our side, but we were down 8% that month, and this other manager was down 0.5%. All right, but it was his first losing month. Now, what's funny about that is this client of mine came to me. He was very, very concerned about the other manager, not about us, but about the other manager. So he expected us to have volatility in our product, and we did have volatility in our product, but he knew we could come back and have huge up months as well. But he was very concerned that the other manager had a first down month, even though it was 0.5%. So the expectations are everything in trading. Now, let me see if I can answer a question. Okay. Okay, negative, okay, stressful environment. This is not about trading. It definitely applies to. Yeah, Bob mentioned here in just a comment that there is your expectations with trading, and the emotions that you encounter are definitely something that's going to affect how you make it through trading. Some of the founding fathers in managed futures were guys who had frequent 50% drawdowns. Now, you think about that. If you're managing $300 million and you lose $150 million, that's half of the money you're managing in a drawdown, that's gonna be a little bit of a challenge. But these guys were so committed, they were so disciplined that they ended up often turning the corner, and they would be back at new highs in 9 months a lot of times. But that's a hard thing to go through. It's a little bit more than I care to go through. I have been through extreme drawdowns myself as well. Okay. How much is too long? It depends. That's a good question, but it depends on the style system that you're using. If you're using a daily, weekly, or monthly strategy on monthly charts or weekly charts, you could see drawdowns that last several weeks or several months, and that would be expected. All right, so just understand that. But if you're intraday, if you're trading with a 60-minute strategy, then a drawdown of longer than 2 to 3 weeks might be something that concerns you. So it's really a matter of studying the past history and understanding what the system has done through various market environments, and then you start to get a feel for what might not be acceptable. And then you add, once you have that that idea in your mind of how long a drawdown could go, you want to usually add a little bit of a buffer on there. So it could even go 30% longer than what you expect, because that's just the way the markets work. So, and from my experience at least. But our goal as traders is to minimize drawdowns. Again, this is beyond the scope of today, but you can do that in one of two ways. You can do that either by managing from the bottom up with your strategies and putting stop loss variations in there. You can do that by also managing your strategies or trading from the top down and diversifying your strategies with strategies applied to non-correlated markets. So we found that over the years there were a few markets out there that really marched to a different drum and oftentimes would do very well when everything else was doing poorly. Like, for example, for us, our fund was up in 2009, and this was a really tough year, one of the worst years ever for a lot of other managers. Well, for us, it really came from sugar. So we actually did really well in sugar that year, and we had a lot of other markets that didn't do so well, and that sugar trading pushed us over into positive territory. So that made a huge difference for us, and that's the type of thing you can do if you trade that way. Now, most of us on the call today are probably looking at more, one or two markets or three markets, and we're not looking as, to a portfolio of broadly diversified markets. But for us, we're probably going to be looking more at the bottom-up approach, where we start to manage our risk with using stops and things like that. So, okay, using your strategies, could we potentially beat the most compared to S&P 500 index? Yeah, I mean, I think so. That should be something that should be very doable as well. But it's not going to be. I don't want you to think that you can just go out there and buy a trading strategy off the market and do that. It's going to take a little bit more of an understanding to do that, a little bit more work on your part, but it's very, very doable to do that. Commitment is key to long-term success. And we used to have a saying in the hedge fund space that we were willing to fly the plane into the side of the mountain. Now, that is not, don't think of the destruction side of that comment. Think about the commitment side of that comment. So we don't want to have our plane ever crash, obviously. All right, but we have to have the commitment level to stay the course. I can't tell you how many managers I've seen over the years who have a good approach to the markets, and then they get in that uncomfortable drawdown, and then they start having their clients call them, and then they change what they're doing. All right, that is the worst thing you can do 99% of the time. Now, there is that 1% of the time where you don't change, and it leads to bad things, and that's probably a topic for a different day. But overall, you can expect your strategies to pull out and do what you design them to do, unless you're in an historic environment where things are just not doing what they should be doing. And we've seen a lot of that in the last couple of years, where it's just been, we've had the 2008 Federal Reserve bailout, the unprecedented printing of our money has caused a lot of things to change in the markets in recent years, and that's something to consider as well. So, okay. If S&P 500 index keeps on going up, would the inverse S&P 500 ETF goes to zero pretty soon? Yeah, John, that's a good question. I would think that, I would have to look at the fund, how leveraged that is, but it could start to go down there pretty darn close to zero. I'd have to think about how the fund is structured. So how often does one have to back test? Good question, Chris, as well. And that is, we had a schedule with the hedge fund of doing that about every 3 to 6 months, depending on the strategy. So, and the idea, was to introduce into the testing the most recent data, because we always believe that the markets were evolving, both in terms of direction and volatility and in terms of characteristics. And so we continued to do that. And that's what we did. Some people don't do it quite that often, but I do believe that you should revisit your parameter settings on a continual basis, on a scheduled basis. So let's go ahead and jump right into why we're here today. Steps to create a strategy. Really start off with number 1 here. Let me pull out my pen, and that is to outline the strategy logic. What are you trying to do? Are you using the RSI? And you're going to buy when it reaches the overbought level, and then sell it when it goes back down to oversold? Are you using a breakout strategy where if the market trades above the highest highs of several weeks ago or several days ago, it's going to buy, and then when it breaks the lowest lows of a look-back period, it's going to sell? So you need to identify the logic. Are you going to use a 2 moving average crossovers as your logic? There's a lot of ways to approach it here, but you do need to have a clear understanding of what you're doing there. Second thing is identify target, market, and time frame. So when I develop a strategy, it's going to be very different possibly intraday than it would be end of day. Now here's some differences that you could run into. With an intraday strategy, I might only be interested in trading during the more active sessions of or times of the session. So I'm not interested typically with intraday strategies in trading as a professional retail or a retail active trader during the night session, because a lot of times that is really choppy and can just end up taking a lot of money from you. You want to also understand, when I say time frame, you might want to consider using tick charts as well. Now, discussing tick charts and TradeStation, one of the weaknesses is that if you trade tick charts in a market that closes and reopens like coffee, a lot of times at 3 in the morning when the market reopens, your tick charts do not start building automatically. So that's a flaw in TradeStation. In my humble opinion, that's been my experience. I'm not beating up on TradeStation, but I'm just telling you what I've experienced. You need to be careful about that regardless of your platform. So if it goes offline because the market's closing and turns back on in the morning with tick charts, sometimes it doesn't fire back up, and you don't want your system to be unmanaged or out there without having the risk parameters and the logic managing your open position. So having a naked position on there without stops or logic is not a good thing. So I found that with TradeStation at least, the time bars typically are more reliable. So the time bars don't have as much of an issue at coming back online with a strategy as do the tick bars. So, but I believe sometimes the tick bars are a nice solution for the night session, because when you don't have the activity, it builds a lot fewer bars and ends up working to some extent better for an intraday strategy. And a longer term strategy, we may want to consider using just daily or time periods, daily, weekly, monthly, or very long term tick bars as well. So identify your market and time frame, and it does matter with the market, by the way, as well. You're going to trade the bonds or treasury notes very differently than the way you trade coffee. There used to be a belief out there with Commodity Corp, which is one of the first money allocators in the future space, that you want to have the same strategy with the same parameters across all markets. And there's a reason why you could say that, and that is that if it works across all markets with the same parameters, it's probably a stable strategy. And I think there's some truth behind that. Now, I believe that there's a better way of doing things. And it's almost like saying that I can get an extra large jersey and put that on all the football players and it's going to fit. Well, the problem with that statement is it's going to look like a dress on the small football players, so it's not the best solution. So my philosophy is if you learn how to optimize your parameters correctly, then you could actually you could actually take that approach and customize it with every market you trade. So a coffee or a soybeans that experiences the parabolic bull market environment is going to trade differently than your 10-year notes or your currencies who don't usually experience the parabolic bull market crescendos. So also understand when you talk about your goals, are you building a strategy for day trading, swing trading, or trend trading? It can make a difference. You can have different considerations. You want to create an indicator along with your strategy. So if I made an RSI strategy, I want to make sure I've got my RSI indicator on the same chart to compare notes. So, So that is important to see your indicator levels corresponding to your strategy signals. I can't tell you how many times in the past where I've built out a strategy and then I look at the, if I just looked at the buy and sell arrows, I would not have detected that the strategy is not actually doing what I've asked it to do. So that's a thing that's very important to understand. You need to confirm that your strategy is actually doing what you've designed it to do. Now you want to code the strategy next. It's fairly straightforward. You've got parameters, you have variables, and then you have formulas and functions and reserved words and things like that. We'll jump into that here in a second. You want to apply the strategy to a market and time frame next, and then again check it against your indicator. And the last but not least, you want to debug your code where necessary. So let's go ahead and go into that. Just a second here. Okay, for some reason my PowerPoint sometimes kicks me out. So can everybody see the outline strategy logic screen here? Okay. All right. TradeStation has only a short history of tick data. Yeah, it should go back, Hugh, for a while. It depends on how far back you want to go. It's a good point. They may limit you to 5,000 bars back. Possibly. This is being recorded, by the way, for excuse me, for those of you who arrived a little bit late here. Okay, do you back test with out of sample data? Chris, that's a good question. I do not. Okay, there's an idea of doing in sample and out of sample, and there's a reason that, I mean, it's a logical question, and there may be ways to do that where it can be effective. But my experience has been that sometimes doing the in-sample, out-of-sample testing and application can be, it's just not productive a lot of times as well. So I do not use that myself, but essentially when you do back test, you are doing it in what we call an in-sample data period, and then we're applying it to what we call the out-of-sample. So you do that in real life. But now I will say that, Chris, this can be a positive from the standpoint of potentially identifying the predictability or robustness of a strategy. So if you try testing from like 2000 through 2010 and then you apply it to 2011, it could give you an idea of how robust a strategy is. So from that standpoint, I think it can be very useful. But from a parameter selection standpoint, I haven't found that that's done me a lot of good. I usually use a different approach there myself. Let's see here. 6 months of tick data. Yeah, that's strange, Jim. I'll have to go back and see unless they've changed something. I've been able to get a couple of years in the past, but that I haven't checked that lately, so they could have changed that a bit. Okay. Yeah. So if you see, can everybody see where it says just outline strategy logic? I haven't typed anything, so if that's all you see, then that's okay. Russ, this has been recorded. Now, let's make a trading strategy. So I'll throw some ideas out there. Do you want to look at breakout? Do we want to look at RSI or moving average crossover? Just to start making something here and show everybody how to make that. Any requests there on what indicator we want to use RSI? Just to start with that. Moving average, okay. Breakout, okay. Okay, but we have a lot of people saying everything. So let me go ahead and start with RSI, and maybe we'll try to do all three of them if we can. So let me throw this up there just 1 second here. Okay, I have to just move around so I can type, which I usually don't do during my presentations. I'll try to speak a little louder. I had to move my mic back a little bit here. All right, so here's the goal. We want to go in, and again, this is TradeStation. We're going to use the same type of structure. So we're going to go to New, and then we're going to go to Strategy here. All right, I'm just going to call this Test RSI, and you can write notes if you want. I'm not going to do that here. And then let's see here. For the template, they have a lot of newer things that they use. I haven't used their template in the past so much, but I'll just press OK. And then I'm going to just go ahead and erase everything they've got there. All right, so let me go back to the TradeStation chart here, and then I'm going to go ahead and apply the RSI indicator and allow you to see what we're doing from a logic standpoint. Okay, here we go. Now, here's what we're going to do. We're going to actually create a strategy that's going to buy when the indicator line goes above 70, and we're going to sell when it goes above or below 30. All right. Now, a lot of you may be saying, "Well, Mark, wait a second here. That's going to be overbought when you're buying and oversold when you're selling." That's the way that a lot of trend followers build strategies, is they intentionally buy short-term overbought or overvalued and sell short-term undervalued. But let's just follow me in the logic here. We can change that. We could also build a strategy that does the opposite and switch that around. So that's what we're doing. You can see the RSI. So where it turns red right here, I'm going to put a vertical line here. We're expecting to buy right there. And then when it goes back down over here, a few bars later, we expect it to actually sell and go short. And this will be a stop and reverse strategy. So let me go ahead and type in the code here that we want to use for accomplishing this. So, okay, we're going to start with putting the parameters up first. So let me go ahead and do that. Okay, so right now, if you'll notice with RSI, the indicator, let me go back to the indicator, you'll notice that it has three parameters that we're really focusing on. We're going to ignore the close. You have the length of the RSI itself, you have the oversold level, and then you have the overbought level. Those are the three parameters we're focusing on. And we're going to essentially do the same thing here. So when you type in or identify your parameters in TradeStation, what you do is you type in the input word input first, okay? So inputs, either singular, I'm going to put plural. First thing I'm going to do is I'm going to put RSI length, and then I'm going to make that a default value, we'll say a 14. Then I'm going to put, second one will be up band, or up level, whatever we want to do. I'll put up band, and then I'm going to make that 70, just like the indicator has it. And then I'm going to do low band, and then that's going to be a value of, we'll call 30. Now, be careful when you name your parameters. You can't use words that are reserved words. So if I typed in low, you'll notice that that actually shows up in blue. I can't use that as one of my parameters. It has to be a word that's not a reserved word in TradeStation. So I've identified three parameters here. Now I need to identify some variables. So VARS is where I define my variables. I'm going to say, let's see here, that my first one, actually in this particular case, I'm not even sure we need to have variables. We may not. So I'm going to leave that blank for the time being and go straight to my logic. All right, so my logic is going to be if, now RSI is a formula that's actually available in TradeStation, and it requires you to have the price and the length. Now for the price, we're going to use close. For the length, we're going to use our parameter RSI length. Okay, and that way we can change this around to determine the best length to go back in time. Okay, if RSI close, the RSI formula is greater than up band, okay, that's my upper level, okay, and RSI, okay, close, then RSI length, there's a quicker way to do this, I'll show you here in a second, is yesterday. Now, last bar's value, I'm going to use a bracket 1 here, okay? I want to make sure that it's a crossover that we're buying on, all right? Because if I just say if RSI value is greater than the up band, then every time it's greater, even after it's crossed over the up band, it's going to continue to try to buy. And that's not what we're looking for. We're looking for a crossing of the up band. So I'm going to make sure that last bar's value was below the up band with this formula. So then buy this bar. Okay, now here's the one thing we can do. I'm going to go ahead and throw something up here so we have the ability to define quantity. So I'll add another parameter, QTY. I'll put 1 there. And then I'm going to go back down to my logic here. Now bear with me if you have questions here. Let me just finish this entering, and then we'll go from there. So QTY, and I'll put contracts. You got to put that in there. Contracts on the close. All right. So this is my first statement here. Now I'm going to go ahead and make this what we call a stop and reverse strategy. Now there's an easy way to do it. Instead of retyping all this in with the opposite logic, I'm just going to copy. So I'm going to highlight the whole thing. Control C. Go down here. Actually, I don't think I can copy it. Control C. And then I'm going to go down below here and Control V. So I copied that. I don't have to do all this over again. Now I'm going to keep my RSI formula the same and then put less than low band. Okay, this is for my sell signal. So I've got if RSI close with RSI length is less than the low band, and RSI yesterday, remember the one brackets here means the bar before. Now I'm saying yesterday if it's a daily bar, it's really the last bar is less or greater than, okay, low band, then I want to sell short, okay. Now this is something that TradeStation has done in recent years, and I'm not sure what I think about it, but they actually have different ways of commanding TradeStation to distinguish between going long and exiting a signal. They used to have exit long and exit short, and I like those better than sell short and buy to cover. That's just probably a personal preference. Okay, so now we've typed this all in, and let's go ahead and click on verify, and this is going to go in and make sure we don't have any errors. Okay, so it's saying that we have an error with my formula here. Let's see what it is. Okay, let me get VARs out of here. I wonder if it's a variable declaration statement. Yeah, that's what it was. So the VARs right up here, I had VARs, and then I had a colon, but I didn't have a semicolon to finish that statement. So that's an error that's a little bit more tricky to find, but if there's no variables, you might as well just go ahead and leave that off. Another thing you could do, let's say if you have VARs here and you're not using it, you can bracket it out, comment it out. So put brackets around it, and that means the compiler is not going to look at it when it checks your code. Okay, so now we have the test RSI strategy. Let's go back to our chart. I'm going to go ahead and insert strategy and go down to test RSI strategy. See if we can find it here. Okay, I think that's what I just created. All right, press close. So I want to make sure that the parameters match up with my indicator. Now, one thing that's different is the indicator puts the low band and then the high band values in that order. I prefer to put high and low. It's just personal preference, so don't be confused by that. And now we see that, remember our two vertical lines here, we were expecting a buy signal up there and a sell signal down here. So this looks, if I go down and eyeball this, I can go down here and see that we sold right here where my cursor is, where the RSI indicator went below 30, and then it doesn't buy it back until the RSI indicator goes back above 70. So we see that my signals are now lining up with where my trade arrows are lining up with where I'd expect the indicator to have buys and sells. So that's a visual check on the logic of the indicator that's actually working. So we can see the whole thing. Okay, Arthur, I'm not sure what you're asking in terms of scrolling back. I can scroll back in time to see how this works. So this is actually one of the earlier strategies that we used way early on in the 90s. This is actually a system that we used as one of our strategies when we won the group of top new managers with Futures Magazine. So we actually traded with this. Now, all we've done here is applied the logic here. We can go in and see what the unoptimized performance is, and we can see right here that over time that's a loser. So just an unoptimized right here, the equity curve is not attractive. Now this should not discourage you, but not necessarily unexpected. So what we can do now is we can click on my arrows, or I can go to Format Strategy, and then we go into Test RSI. We can do what's called optimizing our results. So we assume that the length for the RSI formula 14 is correct, but really we don't know what the best length is. And so what we want to do is test a variety of lengths there for the RSI formula. So I'm going to say 4, maybe 3 on the short side for the RSI formula. Let's make 50 on the long side, increment 1. What that means is I'm going to test length 3, length 4, length 5, 6, 7, 8, all the way up to 50. So a total of 47 results there. And then the up band we're saying is 70. We don't necessarily need to keep it at 70. So let's try maybe 54 on the low side up to 90 on the high side and do increment 1. All right, so down here we'll optimize this. We'll say 10 on the low side, 46 on the high side of the low band, and put increment 1 as well. Now I'm going to say OK. You'll notice that I have 65,000 variations of testing here under test count. So I'm probably not going to want to do standard testing there. I'm going to go ahead and use a selection here under method of genetic, and that takes it down to 10,000, finds a solution much quicker. we don't want to sit here all day and see what the most profitable results are. Now, what's interesting here is just after a few tests, I'm going from a negative profitability, I think we were negative 30,000 or so, up to positive 118,000. So you can see that by adjusting the parameters, by optimizing the parameters now, we have a much more profitable situation. So instead of waiting for this whole test to be conducted, I'm going to go ahead and take the profitable parameters here that have been selected. Now, let's go back to our view strategy optimization report. Now, I can tell you that I don't like these results. This is something that I would never trade with. Now, we can go over here and we can look at our performance summary. Wow, this made $119,000. It might actually be something that works very, very long term. But what I don't like about this is that I've only had, in the last 5 years, 3 trades, and you're talking about experiencing some massive drawdowns in your trades. So right here, for example, the first short signal was generated at 866, and the market sold off, or actually it rallied against that all the way up to 978. So that's over $100 an ounce against you. That's over $10,000 a contract against your position. Now, this could be an effective longer-term strategy, but it's certainly not the best. All right, I'm going to show you something here. See here, Robert, you have a question. Why did you not sell the first time it hit the bottom line? Let's go over here. You're talking about before we optimized it, Robert? Was that your question? If that is, then let me know. Now, what I've done is, let's take our new parameters here. We have 33, 55, and 36. So 33, 36, and 55 will be in that order. I'm going to change those in my indicator. 33, you know what? I always do this. I always forget what I said. Okay, 33, 36, and 55. So 36 and 55. Okay, so I now want my indicator to line up with my my signals, so I can make sure I can verify that trades are happening where I expect them to happen. So I can confirm it there, and then go right over here to the buy signal, can confirm it there. When you asked, I think, Robert, with what you're asking, why didn't it buy the first time it hit the level? It's probably because it was already long. So we were only showing the recent data. I can scroll back in time and see that there was probably another time previous to where we are today where it hit the conditions and it made a trade. All right, so like right here, you'll see back in, looks like 2008, in August of 2008, we went short because we crossed below the lower line. And then shortly thereafter, we can see in December of 2008, it crossed above the upper line, and we initiated a long position. And you can see here by looking at the indicator line, I'm going to kind of scroll forward a little bit here, that the indicator line does not touch the lower line here for a number of years. So we're actually holding this long position for a number of years, and it ends up doing well because we had a great bull market environment. But this strategy in a choppy environment might end up losing a tremendous amount of money. All right, on the first chart, okay, yeah, Robert, it's probably because you didn't see the it didn't show the arrow on my screen. So this is not the entire in-sample testing period that we're looking at on my chart. This is just the tail end of it. So if I go up to format and symbol, you can see that we're going back 20 years on the market. So for gold, I'm going all the way back and testing here, all the way back to early 2000s. So that 2001. And so the previous conditions that would cause a trade are not viewable in my chart. Does that answer your question, Arthur? Okay, I meant the code while you were typing the code. Okay, also, okay, Mark, please scroll back so we can see the whole thing. Okay, is this what you're referring to, Arthur, just the code itself? Okay, okay, yes. So yeah, you can see the whole thing. This is actually scrolled up to the top, so this is all the code right here. I can press enter and get it down a little further into the body of the text, but that is the entire code base right there. All right, Robert, I think I answered your question. The first chart before you changed. So Robert, just verified that I did answer it. It's probably not showing up in the chart. Okay, yeah, good. Conditions there previously were there to buy or sell, but you didn't see that on my chart because I'm just viewing 1 year out of 10 years of testing. So I'm sure that the logic was correct. It probably triggered before okay. Robert, I'm sorry, I'm not totally understanding what you're saying, but try to clarify that, and I'll try to answer your question there. Now, let me show you a quick glimpse. Okay, this is a strategy right here. Let's go to View, Strategy Performance Report, and we'll see if I put a detailed equity curve up here. All right, you can see that this has some fairly sizable drawdowns in it. All right, in fact, I can even go over to my performance summary here first, scroll down to my worst drawdown, and it's $43,000. All right, that's a lot of money for one contract. In general, we're not really interested in seeing that. Okay, now here's what's a little bit deceptive on this strategy. You'll see that the profit factor is 24.13. That makes it look like a very good strategy from that number alone, but the problem is with trend following strategies, when you hold one position for several years and have your largest winner be huge, then that will skew some of these numbers here and make the system sometimes look a little bit better than what it actually is. So I like the equity curve. A picture is worth 1,000 words, and you can see right here that this system can cause tremendous drawdowns. So you can see even up here in recent years that we're having literally $30,000 to $40,000 equity swings on one contract. So now I don't know about you, but for me, that's not necessarily what I'm looking to do. Okay, Robert, the first chart. When you say the first chart, are you talking about the first gold chart? I'm assuming that's what you're talking about, but and then I can throw up, if you're talking about the first gold chart with the original parameters, I can look at that. But I don't understand what you're asking. All right, so let's go ahead and look at another example for gold. Now, this is a hedge fund strategy that we had here and that we used in actual trading in recent years for gold. This is a buy-only strategy. I wanted to show you that's something that's a little bit more advanced so you can see what's out there and what's available. Now, this has a number of parameters with it. Okay, I'm going to go ahead and do an optimization here to show you the kind of thing we did on the hedge fund side. And then maybe we can try to build a quick breakout strategy. So you can see here, I can optimize these numbers, and literally there's a lot of numbers here to optimize. There's a danger in having too many parameters with the strategy because then you can potentially over-optimize it. All right, now if I were to use a exhaustive or standard optimization, there's 137 million different variations for this. So obviously we're not interested in doing that. So you don't want to use what we call brute force optimization or what they call exhaustive. You want to use genetic. All right, and then if you look at your advanced settings, they're usually fine the way they have them. So unless you really have done your homework in terms of generations or population size, mutation rate, and things like that, this is probably going to be fine. So I'm going to select go with the standard genetic settings, and I'm going to go ahead and press optimize here and just let it work for a second. So this is a buy-only strategy going long-only, and this is designed to be a lot more advanced and a lot better with managing risk. So we don't have to go through those $40,000 massive drawdown swings in gold per se. All right, so let me go ahead and just let that run. Okay, is it a lot different from writing formulas and third-party indicators? A lot different. Okay, is it a lot different writing formulas for third-party indicators? Jason, you just want to make sure that you have the function, the formulas that they have. In other words, you want to, if they provide you with a user function that you can draw on, then you can do that. But if you don't have that code, if that's hidden or locked, then you may have trouble referencing the indicator inside of your strategy. Okay, I meant the first RSI strategy. Okay, so a second here. Okay, I meant the first RSI strategy in my question above. Okay, so how could you modify this in the earlier example and get out sooner and then just have many more trades for potentially greater profits? Okay, that's a good question. So let's go back to that here in a second. I'm going to let this run, the optimization run here for a second. That's a good question. So if you want to get out sooner, you can actually shorten your RSI length. So I can enforce discipline. Say I'm going to have a 5-day RSI, and then I'm just going to optimize the entry or the buy level and sell level. All right, that's one way to do it if you want to see what kind of options you have out there. In fact, I'm going to go ahead and Let me change the status really quickly here and shut off my other optimization because I can't do both at the same time. So I'm going to go ahead and abort this other one. All right, press OK, and then I'm going to go back to the RSI to answer your question. So you have the ability to, the question is with the settings we optimized earlier, how can we get it to be more reactive so we don't hold the position through these large drawdowns? So let me go ahead and just optimize this right here, okay, with a shorter time period, but just changing the buy and the sell levels. And let's see what this gives us. And I think this will give us a lot more trades. Now, when you do this, the thing to keep in mind is you definitely want to input your commission costs and your slippage costs as well. All right, so this is, let's go ahead and under View, put Strategy Performance Report. And you see right here, I don't know that we bought ourselves a lot here. We have a lot more trades. Before, I think we had 3, and now we've got 53 trades. Your worst drawdown here looks to be 75,000, so I'm not sure we actually improved things much with that. But what the problem is now instead of riding out big swings in the markets, we're having periods of time where we're getting whipsawed. So from the market peaking, from gold peaking back in, call it the 2011 time frame through 2012, 2013, you literally have a drawdown of around $70,000. So there's a pro and con there with doing that. So we've got a more reactive strategy, but the problem is if the performance environment is not right, then you could end up getting whipsawed. Now, I think this did a fairly good job of buying all the way up here, this RSI strategy in the daily. So if you did long only and you actually were seeing some nice moves that were directional, that was not terribly bad. But then once you got in this choppy period, you started experiencing larger losses here. You can actually see the tone and character of the market changing after it topped out here, so that may be a bit of a red flag for wanting to even leave this strategy on, where before it did a fairly good job, at least in the long side, of capturing some of these long orders. Okay, what are the best parameters for RSI, please? It depends. So the best parameters for what time frame? So I'm not even really suggesting that RSI is a system you necessarily want to trade. I'm just using that as an example, but it can be. RSI can be effective, but I would say that you want to select the environment you want to trade in. Let me just show you a quick example of a hedge fund strategy. I'm going to go to View, Strategy Performance Report. You see a difference there in the equity curve between the previous strategy and this. Now, the hedge fund strategy is trying to do a lot more to manage risk. So instead of having $70,000 swings, we do have drawdowns with this strategy, but it's not nearly as dramatic. All right, so the code is much more advanced here than what you might see. Now, there's a huge negative with this as well, and that is you run the risk of over-optimizing as well. So you've got to be really careful about that. But in general, it can do a decent job of capturing chunks out of the market. So right here, you see we had a losing trade. We bought it, we sold it with a small loss. And then it did a really good job of capturing this next move up here in the market. So going back in time, I'm going to just look at some of my trades, and it does a fairly decent job. The negative is that, well, positive is we missed out on a lot of the chop here, which probably would have ended up costing us money. That's a positive. The negative here is that there are times where we might not even generate a signal. It's like we were a little bit late on this rally right here. We got out a little bit early, but we didn't get chopped up here where the RSI system was encountering heavy losses in this period. This strategy actually did a fairly decent job of riding this out and being profitable. So going back to the RSI example, let's get some questions here. Yeah, we can use stochastic. You can definitely use stochastic RSI instead of just RSI alone, and that's where system development becomes a lot more fun. There's a million different variations of what you can do, and those that you're asking the right questions, and that is, what can I do to improve my performance results? Now, I'll tell you that in my mind, the best way to use automated strategies are in conjunction with a valid and a good predictor of the outlook for a market. So whether that's a swing trade and you're trading on hourly charts, or whether that you're very bullish gold longer term and you're only accepting buy signals from a strategy, if you have that additional filter overlay that could be valid, in your trading, and then you strategically take the signals in that direction, I think that has a chance of dramatically improving potentially your results. The challenge is that we're asking this RSI system to be effective in every single type of environment that we put it in, and that's a lot to demand of a strategy. So it's not going to always do that, but that's what we're asking for it to do, and that's what a lot of managers do in hedge fund spaces. They want their strategy to be on all the time, and they want it to do well during the times where you have a nice trending environment, and then they want the strategy to play very good defense during times where you have massive sideways volatility here as well. Okay, or let's see here. Let's get some questions. So I apologize if I haven't answered your question yet. I'm trying to do this the best I can. Okay, what is the strategy? W, if you're asking about the hedge fund strategy, that's just one we used in with the hedge fund that had more parameters. I would say it was highly effective when we had good trending environments, and it was more challenged when the trending environments went away. Can you share, let's see here, can you share your strategy design target checklist? For example, profit factor. Yeah, that's a good question. For me, when I look at reviewing a strategy, what I would do is I would look at all these different performance measures here in the performance summary section, and there's just a few of these I would look at, but in general what I try to look at now are the percent profitable. All right, that's this number right over here, and notice that for this strategy it's actually less than 50, so 45.28, but if we go over and look at our win-loss ratio, we see that the average winning trade is 2.38 times the average losing trade. So for me, at least, with the style of trading that I'm doing and looking to do going forward, I'm looking mostly at percent profitable and in combination with the ratio of the average win to the average loss. Now, there's a lot of other measures you can use for analyzing trend following strategies. There's ARENA index, I believe it's called. There's the let's see here, some of the ones they have standard here. They have ARENA index down here. The Sharpe ratio is a really good one. Return retracement ratio, or RRR, is interesting as well, and this is really beyond the scope of what we're doing today, but I would say just study the different K ratio as well. You can study these different ratios and see for your style of trading if that's what you want to look at for longer term possible trend strategies. If you're looking at being a shorter term trader and measuring your effectiveness, then percent profitable and ratio of average win to average loss is by far what I look at the most. If you're looking at a strategy over a period of time, I love the equity curve because it pictures worth 1,000 words. I look at this very carefully, and then I also go back and we'll take a look at the strategy actually applied to the chart itself. Now, here's a word of warning here. Let me go back in. We have not put in any of the slippage and commission for this. So in general, commission would be around $3.50. We found that slippage for gold could be upwards of, sometimes it could be upwards of $30 or $40. So I'm going to put $35 here for slippage and commission. And remember our equity curve from before. Okay, so we were profitable, we were positive. Now let's view what it looks like now. Okay, it didn't appear to have a huge impact there because we're trading daily charts, so that's a good sign. If you're trading something really active and you have a lot of trades over time, and you could actually take a beautiful equity curve on the upside and turn it into a just terrible equity curve on the downside. So, all right, of course, if they didn't block your membership. Okay, let's see, Al. Let me get to your question here. Try the Platinum membership test drive. Yeah, okay, that's a good question. For those of you who are interested in test driving a Platinum membership, let me just throw this up there for you to look at. This is an offer. If you haven't come to valuecharts.com, check us out. This is a $7 offer to come and check out our membership. Just go to valuecharts.com/go, and you can try it for 1 month for $7. This is a savings of $200 almost for your first month. If it's not for you, then you risk $7. But we've been growing extremely fast this year. We've got great live trading rooms. I feel like we have a lot of content, and we have some of the most powerful indicators in the markets right now. So I think it'll be, I'm very confident if you're an active trader that you're going to find a lot of value in what we're doing. So we find that most people who come and check us out and check out our live trading rooms, check out our Monday night strategy sessions as well, and our member-only webinars and indicators as well, they tend to really value this and stick around. So there's not many educators in the world you're going to find have come from the hedge fund space who are willing to share what they've learned in the markets. All right, most of them stay in the hedge fund space. I'm planning on going back at some point here, okay. Does the strategy work on Forex? Let's throw it up there. So again, if you want the test drive here, just before I leave the screen, go to www.valuecharts.com/go. $7 is all it costs you to test drive our platinum membership, our top membership. You have trade alerts, a lot of great benefits there, a members-only newsletter every day, and everything else. So we have people who are doing, have told us that it's really helped their trading tremendously, and I would challenge you to take that special offer. It's a one-time offer, so if you're currently a member, you have the charter rate that you can keep on taking advantage of. Let me go back to TradeStation here and answer the question. Okay, well, previous strategy work on Forex. Let's put the euro, let's try the Forex futures, just the euro futures if you're okay with that. That way you don't have to mess with the dollars per contract settings on TradeStation. So this is the euro currency here with the RSI. So let's just take a look at the standard settings that were applied to gold. And actually, this is a good sign. They actually are profitable here on the euro currency, but whether these are optimal or not remains to be seen. So again, we can go in and just run a quick optimization here to see what settings may work best with the euro. And then keep in mind also that when you optimize, it doesn't necessarily mean that you want to actually trade with these, these results. So I'm going to do genetic optimization, and then I'm going to take a look at what they're doing and how the trades are being generated. So, and what I find here is after I go through a few iterations of testing that I can find a pseudo-stable result. So let's go ahead and abort and just take what it's recommending. Let's go back over to viewing the strategy performance report. That's not a terrible equity curve right there. It does have some sizable drawdowns, but for the last 20 years, it does a fairly decent job. Now, again, we have to make sure that we are looking at slippage and commission. The numbers are probably fairly decent for that, and the numbers look, they look okay. So, all right, is optimization an ongoing process? Yes, I would say we would re-optimize strategies maybe once every 3 to 6 months, James, in the trading side. Okay, pretending to have. Okay, logging at computer, see what's happening. Okay, Al, you were saying suggested that you try. Yeah, Al, you're saying. Yeah, such. Of course, if they don't block your. Yeah, hey Al, if you're having issues with that, let me get involved with what you're going on. If you I'll send an email to our customer service if you don't mind, and let me look into what you're struggling with yourself. Sometimes there's issues with the membership that are beyond what we work on, so you should be able to try that out. It's a one-time offer. So if you've taken it in the past, we just offer it one time. People cannot try it over and over again. But if you haven't done that, let me know, and then we'll get you set up. Fair enough? So I'm not sure what the issues you were having with the membership, but I can, yeah. Okay, so yeah, here's a key. Okay. Yeah, hey, I'll take care of you, all right? So I will personally take care of you. Just send us an email at support@valuecharts.com and say, please send this to Mark. And Mark, and I will personally take care of you, fair enough, and make sure that you get set up. So I apologize for any inconvenience there that you've had in getting access to that. And I certainly understand it can be frustrating when you can't log on. Okay, can you point me to the resources that would do the same as TOS platform? Yeah, in terms of, Rizard, you're asking about resources to automate strategies on TOS. Let me see if I can do a little research on that as well. I'm not familiar with the TOS platform in terms of backtesting and optimization, but I can do a little homework for you on that in terms of our services as well. Rizard, if you don't mind shooting me an email at support@valuecharts.com, we'll see if we can get you a comment. And I'll see how our strategies would be comparable or or how they're able to integrate onto that platform. Okay. Yeah, no, we have in-house customer service now that can help you. So again, go to support@valuecharts.com. That's our own customer service in-house, and we will get you taken care of. Okay, is it possible to, and Al, just in case you don't see this, let me just go ahead and throw this up here so you know. If you go to www.valuecharts.com, all right, and then when you get to that page, go down to the lower left-hand corner, and then if you either contact support@valuecharts.com or call this telephone number, those are our folks, in-house folks, and we'll get you taken care of. Okay, is it possible to automate a rule-based geometric spatial based on analysis technique? You should be able to automate anything you'd imagine. So, yeah, but the challenge is if you get, Peter, if you get fairly advanced up there with your logic and reasoning, it becomes more, you could encounter problems with robustness with the strategy, and then you also want to make sure that you're able to actually confirm that your signals generated are in line with the logic that you have for the strategy. Okay, so if that makes sense, then that should be, yeah, that should be what you're looking for. So, but in terms of actually creating a rule-based strategy, you should, with today's technology and today's platforms, create just about anything you can imagine. Okay, now, I've had some people ask, Mark, I want to dive a lot further into this thing. We just talked about some very basic things today about how to build the rule-based strategy, and they can be very helpful. All right, so what I recommend doing is this. I recommend that you go to, let's see, or at least consider my upcoming webinar, How Hedge Funds Trade, and we're going to be going into a lot more detail starting out, and the application of this. This is coming up in the next week or two. So check it out if you're interested, and keep an eye out on valuecharts.com. If you go to our home page here, there's going to be workshops, live online workshops will be displayed there. So this will be something you want to check out. If you're a member, you get a member discount from that, so just reach out to us. This next week, we're going to have two workshops that are free that dive into further detail about what we can do here. So rule-based strategies can be very helpful and very effective. Okay, and that's the way I want to trade myself, but what I think is one of the most powerful ways to trade is to combine that with the ability to identify what I call subjective setups. So if you can get fairly good, and this is a skill that traders can learn themselves, but if you can get fairly decent at finding what you'd call decent setups, then what you can do is flip the switch on for an automated strategy to manage your entry and exit signals in the direction of that trade for the shelf life of that setup. And I have found that that is one of the most powerful ways to trade the markets, and that's how I trade, and that's how I look forward to trading as well. So that way you're not asking your strategy to trade in every single market environment that may not necessarily be a good market environment, right? But you're asking your strategy to be effective when you have what you consider to be a decent setup, and then if you're wrong on the setup, you want your strategy to manage risk and to control that as well. Okay, can you increase the odds by using value bar divergences instead of RSI? Absolutely, yeah. When you combine this information with value bars setups with momentum, support and resistance levels and things like that, you can absolutely increase your odds. So, in fact, I'm going to throw this on a 60-minute gold chart as well. So, for example, let's say this was actually a couple days ago, on May 8th, if you saw a bearish divergence here forming, you could have potentially turned on this bearish RSI strategy and taken some of your sell signals here. And you would have actually been in a situation where you might have made some, had a couple winning trades in a row. And then remember, you have a shelf life here with your signals. So you want to make sure you're not leaving these on. This is actually with euro currency here. But you want to make sure you don't leave it on too far. Once the setup has gone your direction or a certain amount of time has passed, you have a shelf life, then you want to shut the strategy off. And what I found here is that traders can get good at identifying setups over time, or following other traders who are good at identifying setups, like Dave Aquino and Thomas Wood are good at finding setups. And so when you see setups that they find, you could develop a couple automated strategies that you could draw from to turn on strategically, during times where they have found a setup or you have found a setup. Okay, are there rule-based strategies where once you establish a position, the win rate is almost 100%? Once you get in a position, you almost can't lose. Have you found a strategy like that? Have never found a strategy like that, John. In fact, the strategies that I've found historically that have worked best in trend following or longer-term trading have typically had a percentage win rate of around 40%, which means that only 4 out of 10 trades are winners. But what we found is that the win-loss ratio, or the ratio of winning trades to losing trades, can get fairly attractive, and that's where we really capitalize. So we found, the win-loss ratio for some systems would be upwards of 6. So winners are 6 times as large as losers. But obviously, you have to have the right environment to have sustained price movement to take advantage of that. Okay, Mark, in your upcoming workshop, will you be teaching how to code stops? Yeah, we're going to be getting a lot more advanced with what we're talking about. So I'm going to be taking questions in the workshop on how to do things. I'm going to go over a lot of different new types of strategies and how to build in not only like risk management stops. We could look at trailing stops. We could look at chandelier stops. We can look at profit targets. So there's a lot of ways you can build strategies, and and we can look at all those. I say all those, but as many as we can in the time that's allowed. Okay, what is your own direct email address? Al, I don't usually give that out, and the reason why is because I receive literally 200 emails, and I've given that out in the past, and people have gotten frustrated because their email has gotten lost. I would send it to support. If you say, give this to Mark and send it to Min at support, he's going to make sure I get it. We usually that's very, very reliable, and that way he calls attention and gets in touch with me and says, Mark, I need you to respond to this. So that's the best way to get a hold of me. I'm not trying to, exactly, Al. So if you can, even if you give Thomas his, I just don't want yours to creep through. But I'll get you an email address that you can send here, Al, to see if we can get you set up. All right. So okay, will you help us code these stops? Yeah, Veronica, we will. I'll go over that and how to do that. So with this upcoming workshop, we're going to try to make sure that when you leave the workshop, you're going to have a fairly decent level of understanding of how to tackle system design with profit targets, with different types of stops. There's a lot of different types of stops, and I'll tell you the pros and cons in my experience of using each kind over the years, and then how to optimize those as well. So, okay, Drew, let's see here. Okay, yeah, Al, give me a second here, and I'll answer your question. Okay. All right, based on today's examination of performance, is it realistic to test when the historical fact gold, included that the gigantic upward move, that is in the big recession kicked off? Perhaps it is more realistic to examine profit performance just over the past 2 years. Arthur, you hit the nail on the head, and that's exactly right. I'll show you a good example of that too here in just a second, which is more normalized markets, for lack of a better term, normalized. Could you show results of the past 2 years in the RSI strategy? Now, let me just say this. Arthur has pointed out a great observation here, and that is for gold, we're considering in our back testing here what we consider to be possibly even a historic up move in the daily. So going back to this massive bull market we had between 2009 and call it 2012, we are including that, and that's going to subject our strategies to kind of somewhat of a bias. So let me go ahead and go to Format, Symbol, and I'm going to say instead of 20 years back, I'm going to say 3 years back in my testing. Now I'm going to go back in, and I'm going to re-optimize the RSI strategy, and that would probably be a strategy that's going to be much more effective in the current market environment. So Arthur, you hit the nail on the head, and that's getting a little more advanced in sample period testing. But let's go ahead and see what this looks like. So this is a quick little test of the RSI strategy, and I would say that Arthur's right in saying that this is going to be more effective in the current period, right, than including the massive historic bull market. Now, if you expect, let me go ahead and look at the performance results here. This is not terrible. All right, these results aren't terribly bad. You have an upward equity curve in 95,000 net profit out of 130,000. So pretty strong results. Profit factor is very strong for this type of system, and we don't want to make sure also that we have our commission slippage built in, which I believe we do. We could verify that we do, And then also, if you have a look back, if you're trying to optimize for a number of bars back, and it says that you've exceeded your look back period, you want to go to back testing resolution and look at maximum number of bars back. You want to increase this to the maximum period that you're testing for your indicator. So for RSI, we just tested from 5 to 50, but if I wanted to go and increase that from 5 to 100, for example, I could, and that wouldn't be a problem now because I've increased my look back period, or my testing, my in-sample testing look back period for the strategy. Okay, $95,000 over 10 years. Let's take a look at this. View the results here again. So this is just over 3 years. This is $60,000. Really, in fact, let's see when the first trade was. So our first trade we're looking at for this is back in 2011. So call it 2012, maybe 2.5 years-ish of data here of testing. So $60,000 in one contract is not terrible. So that's maybe $50,000 a year that it's averaging. All right. Yeah, so if you look at the longer-term test, $9,000 per contract per year, Rick, is not overly exciting. And that's why what I do is, that's why I like that concept of finding the setups that are strategic using value charts and momentum and other things as well that we teach in our live trading rooms. Those are what I consider to be potentially very strategic entry points. And so if you have that strategic launch point to turn your strategy on, then you could be in a situation where you can increase the probability of success for your outcomes. The higher, improve your percentage win rate, and also improve the ratio of win-loss, winning trades, losing trades. Okay, what would be a good win-loss ratio? Depends. If you're looking at a trending system, I would say that you'd want something to be north of 3, maybe north of 2.5 to 3. But that also depends on your percentage win. So, but I wouldn't be uncomfortable trading a strategy that had something north of 2 or 3. So, and some I've seen as good as 6 or so, but that's back when the markets were really trending. In recent years, we've seen a massive consolidation of markets. Like, let me show you a quick chart here of crude oil. This probably demonstrates what a lot of markets have been going through. And you'll see that we have right now a massive pennant pattern. So we've seen the directional trends contracting here really for the better part of almost 5 years. And so once we see crude oil potentially break out to the upside or downside here in the upcoming weeks and months, that might turn loose a lot of commodity markets to start seeing a lot more bull markets. Although some markets have moved, like we can look at, let's look at coffee. That's had a nice run here, and in recent weeks and months in this year, and probably been one of the better trenders this year. But in general, I think we've seen a lot of consolidation in the commodity markets and haven't seen those extremely good bull markets or bear markets in quite some time. All right, let's see here. Yeah, so this is basically what we were covering today. Now, if you're interested, folks, in delving into this a little deeper, I can try to have another free session. In fact, we plan on having 2 more. I think they're coming up this week. You should receive emails on those invites. If that's, you want to dive into more scenarios here, like a breakout strategy or a moving average cross, we can do that. But I'm a huge fan of rule-based strategies. Okay, let's see here. Mark, what was the performance right there on the crude oil chart? Oh yeah, let's take a look at this. This is on the weekly. Let's pull up the daily here for crude, because that's what we really tested here. View for stop and reverse. This actually was profitable, but not a super attractive equity curve. Understanding the context of crude oil, and this is actually coffee, excuse me, let me go pull up crude oil. Crude oil. Okay. Yeah, see, this is to me, this is obviously nothing that we'd ever want to trade. So you have massive drawdowns, slightly profitable. That would be a system that probably would not be profitable over time. And with this type of strategy, especially on a daily basis, I would caution you in trading this while the market's coiling up in this pennant pattern. So I'd wait for a breakout one way or the other and trade in that direction. Now, we could go intraday. So if you went to 60 minutes, there probably are some nice signals you can take advantage of. I would not recommend a stop and reverse. So we could look at a long-only RSI signal after you see a nice setup. If you're trading off of 60 minutes, then you probably want your setups to be maybe daily even. And then if you're trading on 15-minute charts with your strategy, you want your setups to be from a longer time frame, like 60 minutes or 120 minutes. Okay, again, the last 2 years. Yeah, let's check it out here. Okay, so if we okay, for daily, let's put up daily here, and then just optimize this for maybe, so let's say last 3 years, because part of that will be a period that we cannot test in because of look-back periods. Let me go ahead and just run a quick optimization for crude oil going back the last 2 years-ish. Okay. And yeah, this is a good point. This is actually, we can find a more robust solution here. We've got our RSI right now is finding that the length 3 is much more reactive, and that makes sense because we haven't seen any sustained daily trends here for quite some time in crude oil. We've seen some nice swings. I go ahead and just accept these results. Let's take a look at what this looks like in the equity curve, because before it was not optimized. Yeah, this is better, certainly better, but still you have almost a $30,000 drawdown here, and there's ways to do better than this. All right, and that's, again, you being strategic about when you enter or apply a trading strategy using daily or intraday setups is something that is helpful, and then trading in that direction, and remember the shelf life of your strategy or your setup as well. Mark, in the future webinar today, can you include your value charts indicators to show? Yeah, that's a great question, Steve. Yes, I can. So in fact, this week I'll try to make reference to those. We actually use that in our trading with the hedge fund, and found it was very interesting. We could do a lot with value charts that we were not able to do with a lot of other things. All right, so that's pretty much all I had for today. I think that I've answered a lot of questions here. Let me see if okay. Do you know if any charting service for Larry, let me see if I can answer your question, allow you to program moving averages and make it more dynamic by incorporating current volatility? Larry, you can actually get fairly complex with moving averages. We had one that was using digital signal processing technology that was just a monster, and we used that as a variation of that as a filter with the hedge fund. So you can probably accomplish a lot of what you want to in that. Now, Larry, another thing you might want to check out is possibly using a ATR filter as well, and when you actually activate your strategy or not. So during choppy sideways periods, you could conceivably turn it off as well. Okay. All right. Where do you get your instructions? Okay. Okay, but again, the last 2 years. Al, give me a second, and I'll see if I can get you an email address. Okay, Mark, in the future webinar today, I think we've got that. Okay, post my queue. Okay. Yeah, I'm sorry, Rajesh, if I've missed you earlier. Mark, do you sometimes have issues in TradeStation where your strategy fills are shown at prices that the market never went to, or you need to reload and refix? Yeah, I do, Rajesh, and that usually happens for me when you see like a fill price that's way off by itself. That happens to me in a situation where I use tick charts, and it's interesting. The market's trading a lot faster than the tick charts are updating. Normally with time charts, I don't run into that problem as much, but with tick charts, I have. So, but it shouldn't. If you're filled at a price, that price should show up in your bars at some point in time. Okay, so that you should see that. Okay, the 7-day trial does not include the indicator. That's just a trial. So let me throw that back up there. But you gain access to literally hundreds of dollars of trading alerts and live trading rooms for a 30-day period. So I mean, $7 is obviously worth. That's not a lot to pay for that. So the value there is huge, and more importantly, it gives people an opportunity to check the services out we have and to see how they can help you trade, and they can. Okay, thank you for the fantastic class, Ava. Thank you very much. Appreciate your kind words. Okay, Mark, this morning. Really eye-opening. Many thanks. Arthur, thank you very much as well. There's a lot more to come. So I would challenge you, if any of you are interested in furthering this research on automated strategies, then I'm going to start to try to commit myself to doing a lot more classes on this. And we have one coming up, how to trade like the hedge fund, here soon. And literally, I'm going to try to communicate a lot of my experiences I've learned over the last 20 years and get you up to speed if you're interested in trading automated strategies. Can you automate value charts, red tips? Probably, yeah, you probably could. You'd have to define your entry point. You can do that using limit trades, William, and then you also have to play around with different exit scenarios as well. Okay, let's see. All right, I take that's possible to use value charts as smart money indicators to code all these strategies. Yes, you can. And in some cases, we may have to just get access for you with functions, but or formulas. So if you don't have those, we'll work with you to try to get you those. Yvonne, thank you very much for your kind words. Okay, let's see here. Okay, have you ever heard of taking the max drawdown amount not exceeding 10% of your profit of your strategy as a performance rule? There's a lot of hedge funds out there and managers out there that do very interesting things when drawdowns reach a certain point. They usually do that on a portfolio basis, but you probably can do that on a system basis as well, meaning that once your losses exceed a certain amount or a certain percentage amount, you can trade differently, reduce your position size, or shut the strategy off for a period of time, or things like that. Okay, can you show your indicators on the Ninja platform in the future? Yeah, Steve, I'm going to try to do a pure Ninja presentation here at some point, and I know that that is different and that would be helpful. So bear with me. I'll try to coordinate with the folks at Ninja and start to do some more kind of purely Ninja stuff. Gordon, thank you very much. Appreciate having you here as well. Okay, can I get a recording? Value charts webinar, thanks. Yeah, Henry, if you're asking for today's recording, we have that. As a member, by the way, for those of you who are Platinum members or take advantage of this one-time promotional offer, we have a lot of recorded videos as well posted up there that you can have access to. Okay. Okay, excellent, Veronica. We'd love to have you there, and we can take this education a lot further on, and I think it's going to be very value added. There's a lot of things that I've learned the hard way over time, and if I can do anything to prevent you from learning the hard way, then I'll do it. Okay, Bob, I could not attend the GoCharts webinar. Okay. Yeah, let me talk about this. GoCharts is a platform we're working on, and we had a beta launch, and then there was a time series issue we've been having with our servers. We want to fine-tune. I want to make sure data is streaming right, and sometimes when the different browsers out there, they update their technology. We just want to make sure that it's right on the mark where we can get streaming, very reliable data. So that is something we're working on right now, and I'll keep you posted. We'll try to make some more announcements there, and then I'm going to try to also have a GoChart a YouTube video center up there as well. So we'll stay tuned. Bob, if you're interested in becoming a beta user at all, just you shoot us an email at customer service, and we'll get you taken care of. So, okay, are you planning on doing another webinar on GoCharts? Yes, Rajesh, we are. We want to make sure we iron out the time series issues, and I apologize for that. It's one of those things that popped up early on in the beta that I was seeing. I was wanting to make sure that got fixed before we get too far down the road here, but they're working on it right now. They've got completion dates for late May with that, and hopefully we'll take care of that. So, okay, can you describe GoCharts? GoChart is a platform that we're designing that allows us at MicroQuant to build out all of the cool indicators that we created that are outside of the box. So it really gives us an ability to design anything we can imagine. And the other thing about GoChart that's really going to be special is it's designed to connect you to the educator. Right now, if you think about that for a second, there's a lot of the trading platforms right now are not connected at all, if very little, to educators. This one, the meat of the design is to do that. So you're going to know what your educator is thinking about different markets, and be able to practice and do things that other platforms do not allow you to do. It's just a little bit of a sneak peek there, in terms of what we can do. So that will be coming out here in not too distant future. Cost for GoChart, we project to be right around maybe $29 a month or so. So that's including the data feeds delayed. Now, exchange fees are not included in that, but we're trying to get that. With a lot of the core data feeds, either delayed or real time for Forex, built into that. We expect to have that, and then also you'll be able to gain access to all the indicators you have. If you purchased indicators from Smart Setups or Value Charts, as we get those up there, you will not have to rebuy those. you're going to get full access to those indicators. Okay, when is the American Express card? That is fixed, actually, James, on GoChart. So we've actually fixed that. If you're interested in being a beta tester, we're creating a group right now, and there's no charge for that. Okay. All right. Will trade off the GoCharts? Yeah, James, the goal is to be able to trade off the GoCharts as a fully functioning trading platform. All right. Well, thanks for coming out and joining me today, folks. I appreciate it. Yeah, give Mint a call, James, if we can help out, and we'll get you set up. Folks, appreciate you coming out today again. And we covered a little bit of stuff, but next time, if you're interested, join us in the upcoming workshops that we have. They're free, and these will be hour-long workshops. I'm going to try to dive in and get to a little bit more content. And then we have the paid workshop coming up where I'm really going to try to dive in and try to get any of you who are interested in automated strategies a lot further along, to where at the end of the workshop you should feel fairly comfortable with concepts of designing strategies and testing them from a lot of different angles. And I'm going to go over in much more depth about some of the problems I've had in the hedge fund world to save you the same frustrations and hopefully advance your education along fairly rapidly. So again, Arthur, thank you very much. You have a great weekend as well. And folks, I appreciate your time. So, all right, have a great weekend. This will conclude today's session. This is recorded if you want to watch it, and will be available here in the next couple of days. Steve, thanks as well, and everybody else.